Okay, so methods of deferred tax. So deferred tax is also a non-current item, as the tax is not currently owed by SARS, right? So it's recognized as a non-current asset or liability, depending on if we have an asset or liability. So there are two methods in which we calculate our deferred tax. So it's the income statement approach, which I showed you guys, and there's also the balance sheet approach. So IAS 12 refers to the balance sheet approach, and the income statement approach is used as a test, right? So the balance sheet approach, we measure our deferred tax based on the difference between the carrying amount of assets and liabilities and the tax base of each of the assets and liabilities. So we will focus on the balance sheet method, right? So the income statement method is useful to understand the concept of deferred tax and the fact that it is rooted in the accrual concept, right? So we have a deferred tax adjustment to adjust our current tax to what our total tax or total tax expense is, or what our tax incurred on accounting profit should be, right? So it's just an adjustment from current tax to our total tax expense. That's what our deferred tax adjustment does. Alright, so the income statement method is useful for us to check our balance sheet method calculations, right? So the thinking behind the balance sheet method is that the deferred tax balance, whether the balance is a liability or an asset, it represents the expected future tax which will be payable or receivable, that will be levied on the expected future transactions that have already been recognized in the financial statements. So now you'll probably be like, it is an expected future tax, right, which will be payable or receivable based on expected future transactions. And you're probably thinking, future transactions, we only record transactions when they have been incurred or when they have been earned, right? So you're probably thinking future transactions. So what am I talking about, right? So let's think of let's start with assets, right? In the definition, it says an asset is a present economic resource, right? That's the first part. So when we talk about the present economic resource, right, we said it is a right with the potential to produce economic benefit, right? You remember the definition from last year. So an asset is a present economic resource with a right, it is a right with the potential to produce economic benefit. So with an asset, we expect future inflow of economic benefits, alright? So when you think of a non-current asset, right? So let's think of plant. Plant, when we recognize it on the financial statements, it is recognized at the carrying value, alright? What is the carrying value of an asset? What does it represent? It represents future economic benefit that we can extract, right? So it's future income that we expect to extract from from our asset. Right? And with liabilities, the definition says that it's a present obligation to transfer an economic resource. So with that definition, it means that there's an expectation that there's going to be an outflow of economic benefits. So we're going to have future expenses. Right? So we're going to have future expenses with an income. We're going to have future expenses with our liabilities, and we have future income with our assets. So, let me go to the next slide. Alright? So the question is, so then, what's the logic here? So the logic is that when you think of the current year's profit on our statement of comprehensive income, right, we present our current year's profit, alright? We show our profit before tax, we have our total tax expense, and then we have our profit after tax. So then the same applies to future income that's embedded in our assets. So when we recognize our future income, right, in the form of assets, so the carrying value, right, represented by our assets, we should then also recognize the expected tax associated with that future income, right? So when we have future, so when we recognize our future income, we should also then recognize the expected future tax. And that future tax is then known as deferred tax. So, just to repeat what I said earlier, deferred tax balances whether it is a liability or an asset. It represents the expected future tax which will be payable. So if we have a liability, it will be payable. If we have an asset, it will be receivable, or it will be a saving. Right? So it is a future tax which will be payable or receivable that will be levied on the expected future transactions. So future income, future expenses, right, that have already been recognized in the financial statements in the form of our assets or our liabilities. Right? So our future tax payable, right, will be a deferred tax liability. And if we have a future tax saving or a future tax receivable, and we will reference it as a deferred tax asset. So the carrying amount, so I'm just reading again from the slides over here. So the carrying amount of the assets represents the future income, future economic benefits, which will lead to future taxes. And so the carrying amount of the liabilities represents future expenses, which will lead to future deductible taxes, right? And so the balance sheet approach, it requires that the carrying amount of the assets and liabilities be compared, and the tax base of the assets and liabilities, which is exactly the same thing I said on the previous slide. In order to measure our deferred tax, we compare the carrying amount of the assets and liabilities and then the respective tax bases as well. Alright, and so we calculated by saying it's a difference of our carrying amount of our asset, which will be your future income, and then the tax base of the asset. So when we talk about tax base, we need to put on our tax act again, right? And so remember, what is a tax base? The tax base is the tax base of an asset is future deductions in the form of wear and tear or capital allowances. Okay, so I'll talk a little bit later. I'll delve in a little bit deeper about the tax base of an asset and then the tax base of a liability as well. So again, we measure our deferred tax as the difference between the carrying amount and the tax base of the asset. Alright, so how do we know if we have a deferred tax liability or a deferred tax asset? So remember, a deferred tax liability will be a future tax payable, and a deferred tax asset will be a future tax saving. Alright, so if our carrying amount exceeds our tax base, alright, so remember our carrying amount represents our future income, and our tax base, it represents our future tax deductions. Alright, so if our carrying amount exceeds the tax base, we will have a future taxable profit, because remember the income, so we'll have more income than our deductions, so we'll have a future taxable profit. Alright, and so we will then also have a future tax payable, and that future tax payable is known as our deferred tax liability. If our carrying amount is less than our tax base, remember the carrying amount is our future income, and then our tax base is our future tax deductions for the asset, right? If our carrying amount is less than our tax base, we expect a future tax loss, right? Or we can say that we expect a future tax saving, right? Because our deductions are going to be more than our income. And then that future tax saving will reduce our taxable profit, and thus will reduce our current tax. So if our carrying amount is less than our tax base, we will have a deferred tax asset. If our carrying amount is more than our tax base, we'll have a deferred tax liability. Did I say that right? If our carrying amount is less than our tax base, we'll have a deferred tax asset. Okay, that was right, correct that time. And if our carrying amount is more than our tax base, we'll have a deferred tax liability. Alright? And so then on the slide, we have our carrying amount, we have our tax base, and then the difference between the carrying amount and the tax base is our temporary difference, alright? So if we have, if our carrying amount is more than our tax base, we will have a taxable temporary difference. And if our, if the carrying amount is less than our tax base, we will have a deductible temporary difference. Okay, I'll repeat that again. If our carrying amount is more than our tax base, we will have a taxable temporary difference. So if carrying amount A is more than our tax base, which is B, we will have a taxable temporary difference. If our carrying amount is less than our tax base, we will have a deductible temporary difference. Because remember, the difference between our carrying amount and our tax base is a temporary difference. And then, in order for us to calculate our deferred tax, right, we would say our temporary difference times 28%. So, when using the balance sheet method, right, we calculate the opening balance of our deferred tax. We calculate the closing balance of our deferred tax, and the difference between the opening balance of our deferred tax and the closing balance of our deferred tax will be known as our deferred tax adjustment. Alright, so remember, I've already spoken about the deferred tax adjustment. Remember, our deferred tax adjustment using the income statement method would be the difference between the total tax expense minus the current tax would be our deferred tax adjustment. When using the balance sheet method, we calculate our deferred tax adjustment by deducting the opening balance and the closing balance of our deferred tax balances. Okay. And so when we recognize or we recognize our deferred tax adjustment. Okay. I think I'm going to stop the video here and I'll continue slide 14 in the next video.